I'd like to welcome to the show Peter Schiff, who is a world-renowned economic forecaster, host of a popular radio program called The Peter Schiff Show, and CEO and Chief Global Strategist of Euro-Pacific Capital. Peter, welcome.
Well, thanks for having me on the show.
So I want to ask you several questions today. The first of which is, of course, relevant to interest rates. My concern that I have with interest rates is that if the Federal Reserve raises short-term rates too much and long-term rates are being artificially suppressed by what's going on abroad, then we flatten out the yield curve, which causes a stall in the economy. But what if I'm wrong? What if long-term rates actually do increase as a result of the Fed's moves? You know, what'll that do to mortgage rates? Could it possibly create another housing crash like we had back in 2008? What's your take on that?
Well, there's a lot to your question there. But first of all, interest rates have been too low for too long. That is the problem. And the Fed needs to allow the market to set interest rates. And I believe if the market did set interest rates, they would be much higher than they are today.
Of course. Yeah.
And of course, by the Fed keeping interest rates so artificially low for so long, not just at the long run, and they've suppressed long-term interest rates with their asset buying, the quantitative easing, but also keeping short-term interest rates so low, they've distorted the economy. And what we've had ever since the last financial crisis was not a recovery, but a bubble. And we haven't
artificially created, exactly.
Yeah, we haven't addressed any of the structural problems caused by the last bubble. We simply compounded them with a new bubble. So all the Fed has bought with all this quantitative easing and 0% interest rates, it is a huge speculative bubble. We have inflated our asset prices and we've gone deeper into debt, but the underlying structure of our economy it's actually gotten worse.
Yeah.
So I think fundamentally we're in worse shape now than on the eve of the last financial crisis, which is why the next financial crisis is going to be much worse. And I think it's going to be a currency crisis and a sovereign debt crisis too.
Okay, so yes, you do believe that could affect housing adversely in even a worse way than it did back in 2008.
Well, it depends on your perspective. If you want to buy a house, it's going to be a positive development to see the prices collapse. See, the problem with housing prices is they're still too high, and most Americans can't afford to buy these high prices. In fact, if you look at the home ownership rate right now, it's the lowest in nearly 50 years. And many Americans who would like to buy homes, who can't afford it, are renting. And if you look at rents have been rising very sharply for the last several years. And now we have people spending record percentages of their income. I think now something like half renters are devoting half their income to their rent.
Just the rent, which is kind of crazy.
Yeah, and so what the solution is lower housing prices, but the government is standing in the way by artificially propping them up with cheap money, government guaranteed interest rates, mortgage rates, 3% down payments. And of course, a lot of the houses now are owned by speculators. They're owned by hedge funds, private equity companies that have bought up all these homes and they're renting them out. But that's all artificial demand generated by the Fed. So I think when this bubble pops, real estate prices are going to come crashing down again. That's going to be a big problem for the banks that have mortgages. But for people who have been struggling, who want to buy a house,
it's an opportunity. Yeah.
It means that the homes will be a lot more affordable.
And I think you're preaching to the choir a bit with our income generation viewers who are concerned about, they share the same concerns that you and I both have. You mentioned a minute ago you're concerned about the dollar valuation. Another question is how can, the dollar's been staying strong, money's been flowing into our country, it seems, because as I've said before, we are the the cleanest dirty shirt in the world's economic hamper, so it seems, at least on the surface. But what happens now while the rest of the world is easing and we're tightening? How does that affect the dollar?
Well, it's more about perception. Everybody believes that we're going to be tightening while the rest of the world eases. And it's those perceptions that have driven the dollar rally. Yeah. But the perceptions are wrong. What's actually going to happen is we're going to be easing again while the rest of the world is tightening. You see, normally when the Fed raises interest rates for the first time, right, it's as a recovery is just getting underway. But this time the Fed has waited so long that the recovery is almost over.
Yeah.
In fact, I think by 2016, we're going to be in a recession again. And so rather than the Fed continuing to raise interest rates, I think they're going to do another round of quantitative easing. We're going to do QE4. It might be the European Central Bank that ends up raising rates before we do and ending their program just as our quantitative easing program is getting started. And remember, all that flow of foreign money into the U.S., it didn't go into building factories in America. It went into speculating in financial assets, stocks and bonds.
Debt, sure.
And it went into finance consumption. If you look at our trade deficits, they've been growing dramatically recently, just as our manufacturing and production have been declining. So all this hot money is going to leave even more quickly than it came. And I think the real threat is going to be a collapse in the value of the dollar that is going to send consumer prices much, much higher and put the Fed in a real conundrum, because inflation is going to be well north of its 2% target, yet it's not going to raise rates because the economy is going to be back in recession, and they're going to be fighting that.
Well, that was one of the next questions I was going to ask you then. If you feel as though inflation will be well over 2%, clearly you're not in the deflation camp. You're thinking more if our currency gets devalued, we have hyperinflation. Do you believe that the CPI index is or is not an accurate reflector of the inflation that your average income generation citizen is experiencing?
No, I don't think it accurately reflects it at all, and I think that's deliberate. That's by design. See, the government came up with a formula for measuring inflation, and obviously they want a low number, right? If you hired the mafia, to do a survey on crime, right, they're not going to come out and say, oh, there's a lot of crime, we need more police, right? They're going to come out and say, hey, everything is great. Or if if a child is going to grade their own report card, you wouldn't be surprised if they had straight A's. So this is what's going on, right? Yeah. We put the government in charge of reporting on inflation. And it's not that they fudge the numbers. They don't get a number and then just make it lower. It's the methodology that they use to calculate the CPI has been changed so dramatically over the years that now it's almost impossible for that number to ever be high. Yet the government relies on that number supposedly as proof that they can keep printing money because it's having no effect on prices. But meanwhile, the average American feels the effects of inflation when he goes to the grocery store, when he pays his electric bill, when he pays his rent.
Everyday expenses for our viewers. I get that.
And look at health insurance. Look at education costs.
We need to take a quick break, but we're going to be right back. And when we come back, we're going to ask what Peter thinks is the big surprise. We'll talk more about inflation, but we'll ask him what he thinks the biggest surprise is in 2016 that we might just not be expecting. So stay right here. We'll be right back. World-renowned economist Peter Schiff. Peter, I apologize. Before the break, I had to cut you a little bit short. You didn't see because our producer was behind you waving his arms saying we have to take a commercial break and keep our advertisers happy. So continue talking a little bit about inflation and what you were saying about how the government measures it versus how our average viewer feels inflation.
Well, first of all, you have to remember that inflation is not a rise in prices. That is the result of inflation. The inflation is the expansion of the money supply. That's literally what's being inflated. And of course, we all know that money supply has grown dramatically. The Fed's balance sheet is now $4.5 trillion. So all that inflation has already been created. And it affects prices in different ways. Sometimes inflation shows up in financial assets before it shows up in consumer goods.
So what's going to happen?
Yes, we see it in real estate, we see it in bonds, we see it in stocks, we see it in collectibles, rare art, antique cars, all sorts of things have been bid up with all the inflation, all the new money that the Federal Reserve has created.
Sure.
But consumer prices are rising, and I think they are rising faster than the government measures show, and the government doesn't want to acknowledge how fast prices are rising because then it would have to be much tighter in its monetary policy, but it doesn't want to do that.
Not to mention the fact that it has to give bigger cost of living raises to people receiving Social Security, people receiving government pensions, and all that.
So that just drives up the deficit.
Like the wolf guarding the hen house.
And also, if the government were to accurately report inflation, it would be obvious that the economy was growing more slowly, or in fact has been in a continuous recession for the entirety of this supposed recovery. And in fact, that's why the recovery is so weak, because it doesn't really exist. I mean, if you look at the collapse in full-time employment over this recovery, if you look at the collapse in real incomes and household net worth, we've never seen a recovery where people were poorer at the end of the recovery than they were at the beginning of the recovery. This recovery looks more like a recession. And maybe because it is, because the government is not being honest in the way it reports the inflation numbers.
It's interesting. I mean, do you think that quantitative easing at all was a good idea, the TARP program? Or?
No.
You think none of it should have existed, even
No,
the TARP program?
they were horrible ideas. What they did is they bought some time, but it was going to be very expensive. We postponed the pain, but in so doing, now the pain is going to be much worse because the problems have gotten much worse during the years that we've postponed the pain. But of course, all of the programs, quantitative easing, 0% interest rates, that was only supposedly necessary because the Fed inflated the housing bubble in the first place. So it's like the Federal Reserve lit the fire, and now we're trying to give them credit for putting it out without blaming them for lighting it in the first place.
The fireman who's an arsonist.
But they didn't actually put it out. It's just it just looks like it's out. It's going to come back larger than ever.
I can't argue with anything you just said. That's why it's such a pleasure having you here today. So since our commercial break, our viewers have been waiting with bated breath, waiting to hear what predictions Peter Schiff has for 2016. Things that, not things that are obvious, but things that maybe people might not be looking toward.
Well, a lot of things could go wrong in 2016 based on the perception of the markets. I think people are going to be surprised by the about-face in Fed policy. For the last several years, everybody has been looking forward to the Fed tightening, and I think they're going to reverse course, and now they're going to be talking about easing. Maybe they'll start doing it, or maybe they'll just be hinting at it. Maybe they'll
in 2016.
Yes, and maybe they'll even launch QE4. Remember, it is an election year, and the last thing that Janet Yellen wants is voters going to the polls in a recession, at least in an official recession. I think Janet Yellen is very partisan, and I think she probably views herself as part of the Obama administration, just like Ben Bernanke thought he was part of the Bush administration, and then the Obama administration. So I think she's a team player. She wants to keep her team on the field. She wants to see Hillary Clinton elected, and she believes that the Fed can achieve that by printing money and buying government bonds, and I think that's what they're going to do. So we could potentially see some big reversals in all of the trades that were meant to profit from the Fed tightening. That would be the dollar reversing course and going down, gold reversing course and going up, as it really becomes a buy the rumor, not even sell the fact, but sell the fact that the fact didn't live up to the hype of the rumor.
Of course. So your reversal from tightening to easing all in 2016. Now, in addition to that, is it my imagination, or does it seem like the Federal Reserve today is worried, maybe inappropriately, about what Wall Street thinks of its decisions?
It's inappropriate, but that's what they do. Because, remember, this recovery is all about Wall Street. It's not about Main Street, right? The Fed is trying to prop up the stock market, prop up the bond market. So obviously it has to pay attention to Wall Street, because that's the beneficiary of these policies. And of course, if the stock market crashes and the bond market crashes, we're right back where we started, because this was a financial crisis. It started on Wall Street. It was the collapse in the mortgage market, right? That's where it all began. So that is what the Fed has been concentrating on. But instead, it should have looked at Wall Street as a symptom of a greater problem on Main Street, having to do with the structure of our economy, where there's too much borrowing, right? Too much consumption, not enough savings, not enough production. But instead of addressing the root cause of the problem, they tried to cover up the symptoms, and that's why the problem is so much worse now.
Okay. Well, you heard it right here. World-renowned economist Peter Schiff is predicting a trend reversal in 2016 from tightening to easing, saying that the Fed is really watching lagging indicators instead of leading indicators, and I couldn't agree with that more. Peter, thanks so much for being on the show.
Yeah, my pleasure.
Hey. And right after the break, we're going to be back with Marty Johnson. As you know, always an informative news report. Stay right here. We'll be right back.